Hi guys, thanks for tuning in to another episode of Nuggets News. Today, welcome a special guest, and that's George Gammon, a friend of mine who's had explosive growth on his YouTube channel. I've been a guest on his show a couple of times now, so I've been dying to get him on to share his knowledge because he has had some awesome guests. And George, thanks so much for joining us, and I just can't wait to dive into a range of topics because there is so much going on around the globe at the moment.
Boy, there sure is. Thanks for having me on. I sincerely appreciate it. And I can't wait to dive in and hopefully give your viewers some great value.
Absolutely. Well, you've absolutely charged. George asked me when he started his channel, how do you go about it? What do you do? This, that, and the other. And I thought, oh, this is a great little channel. I want to help him. And next thing you know, he's got 140,000 subscribers and he's passed me. So well done, George. I guess, where do you want to start? I just think that the most interesting thing for the average person at home is sitting there and watching the Fed say another $1 trillion this week, and then the government and
Right.
Trump says another $1 trillion of spending. And I think the one thing that a lot of people are starting to understand is, well, who gets to create money? And it's now a little bit of a battle between, well, can the government spend it out of thin air? Do they have a money printer? Is it just the Fed that gets to print those dollars? And I also think the banks, and something that you've spoken a lot about, is the banks and lending, and do they get to create money? And this is something that a lot of economists are still even debating about. Does that count as money creation? So I think there's a real power struggle there. And as we go into this world of sort of digital money, they're talking about new accounts, and is the Fed going to have a currency, or is that a government stable coin? So I just love to get your thoughts on how this is all changing, some of the guests you've had on, some of the videos you've done about this money and who gets to create it, and how it's all really just accelerated, I guess, in recent weeks.
Yeah. Well, you've touched on a lot of interesting topics. I'll start with the Fed and money creation and the government, because I think people really get confused here. And I just did a video on it, so it's kind of fresh. It's right on the top of my mind. When the Fed prints money, what they're doing is they're creating bank reserves. So this is what the economist geeks would call base money. So that is just money that's held under the Fed's umbrella. So these are accounts for the primary dealer banks. Basically, they're checking accounts. And so the Fed is printing up these bank reserves, and they're adding bank reserves to the accounts of the primary dealer banks. Let's just call it Goldman Sachs. And they're trading newly formed bank reserves for, let's say, treasuries or mortgage-backed securities. So this would be the Fed's version of quantitative easing, or what most people would consider money printing. Okay. When the government does it, it's different. It's a lot different. And here's how it's different. So when the government spends money, they sell treasuries, whether that's sold out to the public or the Fed monetizes it. It's what they're doing is they're creating additional bank reserves in the system. So they've got, let's say, $1 trillion. And this is in what is called a TGA account. Let me write that down because I need to circle back and I'll explain that because that's very important. But they've got a Treasury General Account that's held at the Fed. So all of this money that the Treasury has since 2008 isn't in the banking system. So it has the power to take these reserves out of the banking system, which it didn't have prior to 2008. That is crucial. So now what happens when the Treasury spends money, again, going back to that $1 trillion stimulus, is let's say they send checks to unemployed people. So those people take the checks, they deposit them in their bank account. So deposits in the commercial banking system, in other words, M2 or broad money. So now we're talking about just base money held at the Fed going to broad money. This is money that can circulate in the real economy and circulates with a lot more velocity, because when those people get the unemployment checks, generally they're going to go out and spend it. So you have velocity increasing there. But anyway, the Treasury spends money, and then when the individuals deposit the checks in their account, their deposits grow. But those reserves go from the TGA to the reserve accounts held at the Fed of the banks where the individuals deposit the money. So now what's happening is not only are the bank reserves increasing, but the deposits in the real economy are increasing. When contrast that to when the Fed does QE, They're increasing the amount of bank reserves, but they're not increasing deposits.
Because they're taking treasuries or mortgage-backed securities as well.
That's right.
Yeah.
They're just trading. It's like Jeff Snyder says, it's just an asset swap.
So
what you've
said there is really important for people to understand, that the government now has a Treasury General Account at the Fed, and all these banks have accounts. So the Fed are kind of like the bank of the banks, and all these other people, the big banks especially, have accounts with the Fed, and that's very different to you or I or businesses and corporations that have accounts with the banks.
Correct. And to be clear, prior to 2008, the TGA, the Treasury General Account, was in the commercial banking system.
Yes.
You see, so it didn't matter. Then what happened in 2008, the Fed knew that they're going to have to come in and do quantitative easing. So they knew they were going to have to create excess bank reserves, more bank reserves than they wanted to. And they were going to have a hard time keeping the interest rate, the overnight Fed funds, above zero, because they were going to flood the system with liquidity and with these bank reserves. So they go to the Fed, or they go to the Treasury, and they say, listen, guys, if you could do us a big favor and take your account from the commercial banking system and bring it under our umbrella, so your account is now with us, and that gives us an additional tool to control reserves, to bring them out of the system and then push them back in, so the Fed can keep interest rates low on the treasuries, right? Well, at the same time, they've got another mechanism to where they can take reserves out of the system if they're too many according to their models, right? You got to keep in mind, this was back prior to hindsight's 2020. So back then they're really worried about inflation, about hyperinflation, all these things. They didn't know how QE was going to work out because they hadn't really done it before. So this was kind of their way to hedge their bets. The problem is they did a deal with the devil, because once they brought the Treasury into the system, let's say, to where they're giving the Treasury control to increase or decrease bank reserves. In other words, they're giving the Treasury the control to do QE or QT. Mm. Right? Then all of a sudden, when, let's say, Trump comes into office, they look at this TGA and they say, wait a minute here. Whoa, time out. This is a game changer. So you're telling me that all this money comes into our account from taxes and selling treasuries and all these things, and we don't really have to spend the money we're obligated to spend right now. We can just trickle it out over the next 2 months, and we can let this account grow and grow and grow. And if this account grows, it's taking reserves out of the banking system. And then that would force the Fed to do more QE if we want them to potentially increase the stock market. And we can save all of this money and spend it right before the election to give a sugar rush to not only the economy, but the stock market, because typically when the bank reserves increase, that expands the capacity on the balance sheets of the primary dealer banks. They're able to lend more money to the financial institutions, to the hedge funds, that do what? Go right into the stock market and buy stocks, taking it to all-time highs, or taking it up to insane nosebleed levels. So I would be shocked if the government, Mnuchin and the administration, if they don't know this, because if you look at a chart, and I'm happy to send this to you as soon as we get done, and you could put it up there, or anyone could just Google the Treasury General Account Fred, and you can see a chart of the TGA. Prior to 2008, the TGA would fluctuate between like maybe $2 billion and $5 billion. It was like chump change for someone like Warren Buffett.
It was a little bit like a household, wasn't it? It sort of came in and it got spent. You live week paycheck to paycheck. And I think I know where you're going with all this. It's just gone through the roof lately, and it's kind of like, when are you guys going to spend this? Is it up to like nearly $1 trillion or?
Alex, almost 1.6. Almost 1.6 trillion. And notice if you look at the chart, or your viewers, I'd strongly suggest they look at the chart. You see prior to 2008, it's just flatline. And then 2008, it starts going a little bit up and down here. And then and then in 2016, it goes up to like, it's really very jagged. It's up and down and up and down. And then in 2016, it starts going up to about 400 billion. But that was the max, right? As of the last 2 months, it goes from 400 billion up to 1.6 trillion. trillion. And think about, and then pull up a chart of the entire money supply, the M2 money supply in the United States, and think about what would happen if that increased by 1.6 trillion in the matter of 2 weeks. And think what that would do to bank reserves. I mean, and then in my video, I took that back, and I don't know if you in Australia have experienced substantial food price inflation, but in the United States, it has been significant. At the prices at the grocery stores have really gone up, and it makes a lot of sense because people's purchasing power didn't really go down that much in the United States because they got additional money. They got more unemployment. In fact, a lot of Americans were making more money by not going to work than they were working their 9-to-5 gig because of unemployment and the stimulus checks, what have you. So you actually increased the purchasing power of the general public, while at the same time you have these supply chains being disrupted with COVID, and there's just not as many goods and services being produced. So what do you expect? Of course, you're going to have some prices go up. And I know there's deflationists out there that I have a massive amount of respect for, and they'll say, well, it's still deflationary. But you've got to pick and choose what you're talking about. And when I talk about price inflation, I'm really talking not necessarily about high-end vehicles or houses or something that you need credit to buy. I'm talking about the stuff everyday people buy every day. Just that's groceries, that's your health expenses, your education, the cost of rent, things like this. That's what you've seen go up. So is it any surprise that we have an incredible, like unprecedented amounts of social unrest, rioting, looting in the United States when you go back through history and you try to examine what is generally the catalyst of social unrest? And whether it was the Arab Spring, whether it was any of these things that you look around the world throughout history, generally it's because the government is doing one of two things, or one of two things is happening. Either the government is taking away a subsidy, or you get substantial price inflation in food. So then you say, okay, look at this social unrest, and you can say it's about the police or the black community, maybe on the surface level. But if you really dig deep, it's because people are angry. I mean, if they struggle to put food on the table, if they see this massive disparity, this wealth gap, they're going to get pissed. They're going to, Americans, and I think people in general, have a very high tolerance for putting up with a lot of government BS. And a lot of BS from corporate America, wherever it's coming down from. But when you start to struggle to put food on the table for your kids, that's when you're hitting the street with the pitchforks. And I think that's what we've seen. So then you take it to the next step and you ask yourself, okay, well, the TGA has got 1.6 trillion and the administration is planning on pumping that into the system just before the election to try to win the election. Then what does that do to food prices? What does that do to the CPI, the stuff that everyday people buy every day? And what does that do to social unrest if we're already at these insane levels that we're seeing right now?
Yeah. So George has gone on a good rant there. There's a lot I want to break down. So, I mean, it's very similar in Australia. So what you said, I think we covered last week that in April or May in America, they had 3% month-on-month food inflation, the biggest it's been for ages. So completely agree that the price of food and that is definitely going up. In Australia, we actually had real inflation of like 6 or 7% for a lot of years through the 2000s. So people are pretty familiar with that sort of inflation in Australia. And it's one of the reasons you've seen like gold in Aussie dollars up near $3,000 an ounce. But really interesting point you make about that Treasury General Account. And if they're actually going to spend all that money, I definitely think Trump wants to give the stock market a sugar rush and everyone a big handout and save the day last minute. And I think M2 is already on pace to grow at like 26% year over year. So it's
hockey stick as well.
And back after the fears about inflation following the financial crisis and the QE, most people know the story that the money stayed in the sort of financial system, not so much in the real economy. So you got all these asset price inflation in stocks, and the rich get richer. But this, what they've done recently, and had to bail everyone out and try and rescue and keep people, employed, because the economy is just on life support. There's a lot more money that's sort of either going to people, and in Australia it's the same. A lot of people are earning far more than what they were with the weekly paychecks from the government. And that's why we're starting to see this real inflation, chasing less goods. So if they keep doing that to the tune of another $1 trillion, then yeah, it's probably going to make everything go up on paper. But I mean, everything goes up on paper in Venezuela as well. So it's only a number on a screen. And I think that is, as you say, at the end of the day, whether it's food or just general inequality, that's when people start to get up and grab a pitchfork. And then the stats in America are crazy. Like, I think it's 1 in 4 children doesn't get enough food. And here we are. The latest thing that the Fed have done again this week is the corporate bond purchases, where the corporate bond market was functioning perfectly well. Like, it had never been cheaper.
They're buying specific bond. They're buying specific. They're not just buying ETFs now. They're buying specific corporate debt. So they're literally picking winners and losers.
And when you look at the corporate funding, I think it was in like 1 basis point of basically corporates could get money if they wanted to. Hertz is issuing shares, big corporates are issuing bonds. They can get money if they want. And yet we have these people that can't afford food and are still waiting on this check in the mail. And the Fed is saying, we need to give these people a few more $100 billion. I just think if more people understood that, there would just be more riots. But any thoughts on all of that?
For sure. And I think it's safe to say that the Fed wants the stock market to remain at a certain level, it remain high. I think that's kind of an obvious statement. So going back to even Greenspan, we've always said that there's this Fed put. Well, if you look at the dynamics of how these bank reserves work, there is and there isn't. I would say, and I agree with Snyder here, and that there's a Fed put, but it's more psychological, because the Fed hasn't gone out and directly purchased shares. Not saying they won't in the future, but they haven't really committed to. But they just increase these bank reserves that gives the additional flexibility to the banks to lend to the hedge funds and whatnot in the repo market. But there still has to be an incentive, a profit motive for them to go in and buy these shares. If they didn't think they were going to make money, if they thought they'd lose money, then regardless of how many bank reserves were in the system, they wouldn't take action, right? So it's more of a psychological thing, and I won't go into that. It's almost like a Pavlovian response that you bring they start to salivate. You do QE and they just immediately start to buy. But go ahead, because
I was going to say, just quickly, that's what we found out when they said that they were going to buy the junk bond ETFs, and then we found out that they actually hadn't really purchased any, but
they went up anyway.
But we'd had that V-shaped recovery, so yeah.
Yeah, but I've started to notice back in March that when the Fed was just coming out with these insane statements. Remember, they were supposed to meet on a Wednesday, and they did that emergency meeting on Sunday to drop the Fed funds by 100 basis points. And then they announced a $1 trillion a day repo. Not that they're doing that, but they're committing to up to $1 trillion a day in repo, and then QE, infinity, all these things. But if you notice, when they came out with each one of those plans, let's say, the market would go up for 2 or 3 hours, and then it would just fall out of bed. It would completely tank. And this is something I started to notice. And our mutual friend Eric Townsend with Macro Voices, he was pointing this out as well, where he said, wait a minute, maybe the Fed put has expired. And that's a big deal. Because if there's no Fed put, that means all of a sudden we're back to real price discovery. And I don't think anyone that's long the market, they don't want price discovery. That's a no bueno zone right there. That's the last thing they want. But what happened is when the Fed, these programs started to not work and the market was tanking, actually even worse, then the government came in and said, well, wait a minute. Now we're going to come up with this $3 trillion stimulus package, and stimulus this, stimulus that, stimulus this. And then the market started to quote unquote recover. And then it's gone back up. And each time the market kind of goes up, it's because Trump's coming out with a new $1 trillion stimulus, or the checks went out, and this company was saved. And it's all about government spending.
Yeah.
So it's more fiscal than it is monetary. So my hypothesis is we've gone from a Fed put that could have expired to a government put. And if we've gone to a government put, that puts us in stagflation, like just that's primo setup for stagflation. Because going back to our original conversation, when the Fed comes in, does quantitative easing, let's say does a Fed put, they're creating bank reserves that aren't necessarily creating deposits in the real economy. That's one of the reasons why you saw M2 go up, but you saw velocity since 2008 just plummet. In fact, velocity goes down probably at the same rate as M2, and the Fed's balance sheet goes up with quantitative easing, right? Because what's happening is M2 is getting out maybe to the economy, but it's centralized in fewer and fewer bank accounts.
Well, what I was going to say, if I could just jump in quickly, what George is saying is that when the Fed creates these extra reserves, and the same's happened in Australia and around the world, where they've said, here are these programs, here are the reserves, but people still need to go in. And small businesses that don't know if their restaurant's going to reopen or if they can afford to have 20 staff still, they're not going in to take these loans and to access these reserves. They're just sort of sitting there, and the people that are accessing them are the big businesses and the corporates and that, who probably already could have got access to capital. So that's the kind of the problem that they're facing.
Yeah, and the mom and pop business on the corner, even the decent sized businesses, the transfer mechanism to get them the bailout is still the banking system. See, they're the ones that are the banking system and the government. And prior to what's going on now is mostly the commercial banking system. And I'm sure you've talked to Steve Keen and guys like him and Warner. They're right on the money there. The banking system is what creates the M2. Right, because they can have all the bank reserves in the world, and if they're not creating additional loans, then additional money isn't being created. Right. Mm-hmm. So again, the Fed's creating these bank reserves. It's consolidating the M2 money supply to fewer and fewer accounts, even though the M2 is increasing, which decreases velocity. Right. And then if now we're moving to a government put, that means that it's now not just bank reserves. Now it's directly increasing the deposits. And instead of velocity going down, now, because you're doing the opposite, you're instead of consolidating M2 into fewer and fewer bank accounts, now you're dispersing it out through more bank accounts. And those bank accounts that are increasing are going to spend it with velocity, higher and higher and higher velocity. Well, if you got higher velocity, and if you have M2 going parabolic, what's going to happen? What's going to happen to prices? That's kind of a no-brainer. And then you throw the destruction of jobs because of the virus. And even if we have a V-shaped recovery, listen, we're not going back to a 3% unemployment rate in the United States anytime soon. It's not going to happen. There are a lot of businesses that have gone out of business that just flat out won't come back. I spoke with my sister, one of my sisters that used to have a vineyard out in California. She lives in Paso Robles. And one of her good friends in town had this little business where they on I think Thursday, Friday, Saturday nights, they have live music and they do wine tastings, and people would sit at tables. They'd have a little dance floor and stuff like that. And kind of these old rich people would come in and buy these really expensive bottles of wine. Well, that's gone. And in fact, she was telling me that she had a conversation with her friend, and her friend, they just didn't know what to do. They're not going to open back up because although they can, the stipulation to them opening back up is that they have to spread their tables out. So they could only be at 50% capacity where they were prior to the virus, and at 50% capacity, they're not profitable.
Yeah.
Because their margin, they don't have software margins.
Yeah.
Your margins on a food and beverage business are 10%.
Yeah.
So if you're running at 50%, you're not going to make your nut. So they're just having to close shop. And that's just one example. So my point is, you're going to have, even if we get the most optimistic scenario with the virus in the United States, you're still going to have very high unemployment, structurally high unemployment, for probably at least the next 2 years. So you do that and combine that with everything else I said that's inflationary, and you get into this stagflation. And I want to be clear, I'm not one of these people that comes in and says, this is going to happen, I promise you. Absolutely not. I'm an amateur. I've never taken an econ class in my life. I've never taken a finance class. I almost flunked out of high school. But so I'm not saying there's certainties. Like Raoul Powell always says with Real Vision, they're only probabilities. So this is just what I see as the highest probability outcome. We'll see if I'm right or wrong.
Yeah. Neither of us has taken a finance or econ class, guys, so keep that in mind when George and I are talking. That dynamic between the government saying you need to do more to the central bank, and the central bank pushing back and saying you need to do more fiscal spending, we're out of ammo, that actually kind of happened in Australia before a lot of other places because of the housing market and teetering on recession. And it was very interesting to watch Philip Lowe and Josh Frydenberg, our treasurer, sort of talk about that. And then it was really obvious between Trump and Powell and that dynamic there. And some would say Trump won because he got them down to zero and they're printing a lot of money. But I think the other thing where this gets very interesting is the move towards the talk about these stable coins and central bank digital currencies, or government issued, like in China, the government want to do their own. And even for people that don't really understand this sort of stuff, all you need to understand is the concept, as you say, is that it's different to the Fed creating reserves and giving it to the bank. The Fed or the government want to have a ledger or an app or whatever it is that is a direct way to give George money, to give Nuggets News business money. They want a digital account ledger with every person and business, and that is bypassing the banking system. And if the government do it like in China, well, it's making the central bank feel inadequate, and vice versa. So this is where I'm one of the things I want to keep talking about on the channel is this power struggle between the Fed that used to, or the central bank in a country that had a lot of power, and now the government sort of feel like they've got this power, and they're starting to say, well, do we even need to worry about our reserves or our Treasury General Account? Let's just spend and do modern monetary theory and not even worry about what's coming in and going out. And then all the banks that want to feel important because they want reserves, they want to get these loans so they can do the fractional reserves and go and speculate on Wall Street. So that is something that I just think is so interesting. And for the first time ever, we've got more people saying, well, I don't actually want part of any of that system because you just keep printing these dollars that are going to be worthless. I'm going to park some of my wealth in gold, silver, Bitcoin, whatever it is, something that's outside that system and scarce. So that's where I just think that this is the most interesting thing to talk about. And at the same time, you throw in those, like the Brett Johnson, the US dollar milkshake theory, where everyone's trying to get dollars. And now we have all these crypto apps where people can get the US dollar stable coins just by downloading an app. So you've got all these dynamics with the currencies. And I think this is the most fascinating thing to talk about.
Yeah, but even Brent will say, and I've had this conversation with Brent, so I don't want to put words in his mouth, but I'm pretty confident that he would say that there can totally be consumer price inflation in XYZ country, while at the same time, that country's currency on the foreign exchange market is actually appreciating against other currencies. And that's why whenever I think about the dollar, I always think about it as two separate currencies. You've got the domestic dollar, and then you've got the international dollar. So the international dollar is what we see on the DXY, that is competing against a basket of currency, mostly euros. Yes. And then you've got the domestic dollar, and that's where that's being compared to the price of assets denominated in dollars, or the prices of goods and services that you can buy with those dollars. And what's interesting there is the transfer mechanism, because how do you get the dollars from, let's say there could be an oversupply of dollars within the United States, but a lack of dollars outside of the United States, because there's not a real efficient way other than global trade to get those dollars outside of the country.
And do you think?
And then if you want to talk about global supply chains coming back into the United States, well, that reduces the amount of dollars that could potentially leave the country.
Do you think that's one of the reasons the US dollar has been weak lately, is because the global supply chains are sort of breaking down? There's less velocity of US dollars going around the world, so all of a sudden there's less people paying their bills each month. All that global trade happens in US dollars, so there's less demand for US dollars at the moment? Or do you think it's more a function of, oh shit, they're printing $7 trillion, it's got to weaken their currency to some degree?
I think it's both. And I'm not even close to smart enough to know what's going on with the dollar, because when you get into these global FX markets, like there are just millions of cross currents. So to try to determine what cross current is taking over at any given time, I mean, it is way above my pay grade.
Yes,
that's for sure. But I think it's probably a combination of everything that you're talking about. You got oil. You've got the collapse in a global economy. You've got oil down, at 35 a barrel, something like that. That's going to have less demand for dollars because oil is denominated in dollars. While at the same time, you've got these swap lines that have opened up. And I think Lynn Alden, one of the people I'm partnering with Rebel Capitalist Pro, she's done a lot of study and research on the global assets denominated in dollars. So if they really get into they meaning the corporations and the sovereigns, if they really get into a pinch where they need dollars to pay down dollar denominated debt, her view is they've got a lot of dollar denominated assets that they can sell to get those dollars to pay those debts. So there's just a lot going on, and that's why macro is just so fascinating. It's so fun to really figure out. But going back to the government put, and if the government is now in charge of the housing market in Australia, or if the government is now in charge of elevating the stock market in the United States, that just gives us a whole different world when you view it from the lens of a Bitcoin, a gold, or a silver.
Yeah,
it's not your dad's quantitative easing. It's not your dad's Fed put anymore. Meaning it's not something that is where we don't have to worry about inflation. And especially if you go back to what you're saying about the Fed coin, and in the United States, they had a hard time getting the checks actually out. Shocker, you put the government in charge of something and they don't do it well. Yeah. But so in the future, I think, download the Fed app. What better way to get people using the Fed coin, or the Orwell, as Eric Townsend would say? Yeah. But what better way? If you want to use your Orwells or your Fed coin, you got to download the app. And then every month when we have UBI or whatever it is, we'll just create another 1,000 Fed coins on your app, and you just go to Starbucks and you just swipe it, and bam, there you go. It's the easiest thing you've ever done. But what this does is it also gives the Fed and or government the power to kind of micromanage velocity. And as you know, the United States is almost 26, they might have crossed the threshold, $26 trillion in debt.
Yeah.
So they have more debt than any nation in the history of the world by a long shot. The only way that they can get out of debt is by defaulting, or by defaulting by inflation, which I would say is still a default, but it's pick your poison. Do you want to inflate your way out of it to where you're able to pay things back with cheaper dollars, or just default? So most likely they're going to choose option A, or try to choose option A, where they inflate away the value of the debt, Well, what better way to do it, Alex, than if you've got all these people with their $1,000 a month Fed coins, but what you tell them, and you know this is possible because you're a crypto guy, that at the end of the month, if you haven't spent all your Fed coins, poof, they're gone. They're, so you're not only getting that money into the economy efficiently, but you're also able to control how quickly people are spending it. And you could also set it up to where they couldn't use it to pay down debt.
Yeah, so
because then you're restricting the money supply.
I've been working on a big thesis around. It's called the digital Thickshake theory, and it's a play on Brent's US dollar milkshake theory. And there's demand for all these dollars around the world. Now, once you go digital, and anyone doesn't even have to be Fed coin in America, anyone in Africa or Russia with an app can download and get a US dollar stable coin. And two things I haven't heard many people talk about yet are what you just said, where they can penalize you at the end of the month, but also how they can enforce negative interest rates on the Fed coin. And I think this is another bullish case for Bitcoin or even stable coins, because you can say it's the last day of the month, I'm about to get negative interest, or I'm about to lose my last 100 Fed coins.
It's pretty much the same thing. Negative interest rates are just, putting the kibosh on it. Same thing.
And someone says, well, I'm going to buy 100 Fed coins worth of Bitcoin, or I'm going to go out and buy that decentralized US dollar stable coin that doesn't penalize me. And the Fed don't really know. Maybe they do, but at the end of the day, you've still spent it. So there's going to be ways around these sort of things. And you can say, well, hey, I invested it in Bitcoin, and then you went to a US dollar stable coin. So there's all these ways where no matter what they do, there's this new system where you can sort of fight back or push back against it for the first time ever. And again, I think that crypto has just got such a huge role to play in where this is all going.
Or just think what that could do to the stock market. I mean, there's nobody that's more bearish on the stock market from a fundamental standpoint than I am. But I admit that there are ways, because now it's fundamentals are completely out the window. It's all about liquidity and capital flows. So I'm the first person to admit that it could go higher, higher, higher. Who knows? That's why it's not really. I like talking about it and I like thinking about it, but I don't place bet. I don't invest based on my opinion of the fundamentals of the stock market. But think about that. So you're an average millennial, and you're just trying to side hustle just to make ends meet, and you're getting $1,000 a month from the Fed or from the government in these Fed coins. Why on earth wouldn't you just buy stocks with them? So you save up all to the end of the month, and before they delete it from your account, you're just like, whoo, I'll buy Tesla. Whoo, I'll buy Hertz.
And that's what's happening already with Robinhood and all these apps.
Get free money. They're like, well, what's my downside? Listen, I'm playing with the house's money. And this is something I haven't heard anyone talking about. They're saying, yes, that it's these millennials and they're foolish. And well, are they foolish? Maybe it's smart, because, again, they're playing with money they just got from the government. It's manna from heaven falling out of the sky. So why not put it into the most risky thing possible? Because in their mind, they see it, you've got the most upside. So if my downside is I just lose everything that I just got from the government that I didn't have last month anyway, and I didn't have to work for it, so I don't see any value in it. It's just like monopoly money. Why not just gamble it by buying Nikola or something like that? And then if I increase my money 1,000x, well, now all of a sudden I'm rich for free, and I had pretty much no downside. So think about what yours. And I didn't even think about that. But if they're doing the Fed coin to the app and then doing negative interest rates, or just deleting the money, reducing the purchasing power within a certain amount of time to make you spend it, why would you not go into Bitcoin or go into gold or silver? And then why on earth would these millennials not go into just the most risky companies in the stock market they possibly could? I mean,
and when you look at the market cap of the Hertzes or the Nikolas or these risky things that millennials are getting a taste for, but in the world of crypto, we've started to see the altcoins have a little bit of a 2017 sort of mania picking up again. You might have heard this buzzword DeFi, decentralized finance. There's basically, in Ethereum, which is the second biggest coin, there's a lot of projects building on top of that, and they have their own coins, and there's some very, very good projects, probably about half a dozen. But now it's become a buzzword, a little bit like ICO did. And we're starting to see these projects going up hundreds of %. And I think that the millennials are going to see, oh, look at that. Hertz is up 300%, crypto's up 1,000%. And I think we could have a bubble bigger than the 2017 crypto bubble if we have all this free money and these handouts, and millennials have discovered investing, and then they see Bitcoin and these other things going up more. But
Do you think they would? Do you think those flows would go into the altcoins more that are more risky because there's more upside, or flow equally into Bitcoin and things that are more, let's call them stable?
no, a millennial sees a Bitcoin for $10,000, or they see an altcoin, and the altcoin makers deliberately make them 1 cent instead of 10,000. And so millennials go, I can buy half a Bitcoin, or I can buy 1,000 of these tiny little coins, and that's where you get these speculative manias in penny stocks. And because their market caps are so small compared to the Hertzes of the world, these things have got potential to just pop and create a huge bubble. And I do think that that is probably something that's back on the cards, which I didn't really see a way for that to happen again. But now they're handing out money and people are speculating on Robinhood. I definitely think that it's back on the cards.
Yeah, and at the end of the day, it's just a massive misallocation of capital. I mean, it's a misallocation of resources in general. It's a distortion of markets. So I know a lot of viewers hear that and like, yeah, George, you're just one of those. I hear it from Peter Schiff. I hear it from the Austrians all the time. Misallocation of resources, blah 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 blah. But people don't understand why that's a bad thing. So let's just focus on that for a second.
In Australia, we know.
From an economic standpoint, if you ask yourself, why did communism fail? So obviously, there's a lot of bad things about communism. But if you look at it from a purely economic standpoint, the main reason it failed is because there was no price discovery. That you couldn't get any signals from prices that producers and consumers need to make good decisions, to allocate those resources efficiently. So that's why it all comes crumbling down. So if you think about what the Fed is doing and what they've done for the last 10 years, they've literally manipulated the price of money.
Yes.
That's the interest rate. And money is 1/2 of every single transaction. So basically, they've manipulated every single transaction for at least the last 10 years. And then look at what they're doing now as far as manipulation. There is almost zero price discovery in the stock market right now, in the bond market, in the corporate bond market. I mean, so if we know from looking at Russia and communism and the failures economically of communism in the past, and then layer that over what's happening in Australia and the United States right now, you say, my goodness gracious, this cannot end well. And more bringing it back home to you specifically in Australia, I was talking to Martin North the other day, and you want to talk about a misallocation of resources. He was talking about like 10% of the workforce in Australia is in construction. In new home construction. I mean, what a waste. So you're consolidating, and you're taking an economy that should be very robust and be very diversified with its revenue stream, just like a business. If you have a business, do you want all your revenue streams just from this one sector, this one customer? Absolutely not. That's what Australia keeps doubling down on that one customer. They're allocating all the resources, and they're building an economy. And I hate to be hyperbolic, but they're building an economy very similar to Venezuela, where you're a one-trick pony.
We've just to tie this all together. So the misallocation of capital, it stems back to whether it's the Fed or the ECB or the Swiss National Bank. They're now printing money out of thin air to buy stocks. And the Bank of Japan, they own all those ETFs. They've bought all the bonds. Nothing has any price discovery anymore. And then you take it a step further and you say, well, in Australia, we have 10% in construction. Then we have 9% of everyone's salary has to go into these super funds, and then the super funds want to invest in these real estate investment trusts, and it's all this big game, and the banks have become a huge part of our economy, and house prices are so inflated that 40% of people's wages goes in to pay off their mortgage. So all this money that could be going to starting a business or spending or going on a holiday, it's just a bigger and bigger chunk that's going into a mortgage that you pay. You're a debt slave for 30 years. I just think it is such a sort of Ponzi house of cards type scenario, because all these people have stocks in their retirement accounts. There's 100 houses on each street, and they hear that one sold for $1 million, and now they all get marked at $1 million value, and they go in and they redraw against their house that's worth $1 million.
Right.
But as soon as we have deflation, a downturn, retirement, anything like that start to go wrong, there's no price discovery. It's not really worth that much. There's not 100 people with $1 million that can each afford to buy those houses. There's no people in the stock market that can afford to buy all these stocks with these valuations if anything was really worth what it is. And in Australia the other day, I'm not sure if you saw this, there was these documents released from the Freedom of Information Act that the Reserve Bank of Australia were talking about shutting down the real estate market. They said, we're so worried about a 15% correction that we want to stop the real estate market, put everything on freeze. And that is just insane.
Like closing the stock market?
Yeah.
What?
Yeah, I put a tweet out the other day. It got a fair bit of traction, but still I was like, why isn't Zero Hedge and everyone talking about this? This is huge. And that's when the government came out. I'm sure they have these meetings behind closed doors. That's when they launched the 5% down deposit scheme. They've just increased the first home owners grant. All these things that we predicted were going to happen in our documentary 2 years ago, they're just throwing the kitchen sink at the housing market, because they know if that goes down 10, 20%, everyone's leveraged, then the banks go down, then the economy goes down, and that's it. So just like Trump and America saving the stock market, Australia has to save the housing market.
Yeah, it goes back to Hazlitt. Economics in one lesson. Remember, it's not about the seen, it's about the unseen.
Absolutely.
That's what you have to focus on. So what I mean by that, so the unseen in the United States and in Australia is all of these businesses that haven't been started to diversify the economy, to make it more dynamic and more healthy. All of these things that haven't been started because of the price manipulation, the interest rates, and consolidating and financializing the entire economy into either a housing bubble or a stock market bubble. And at the end of the day, Venezuela.
We're 93rd. In economic complexity, we're 93rd, just below Senegal, Australia.
What's that now?
In economic complexity index, which is the measure of how good your country is at doing different things, Australia's 93rd in the world, just below Senegal. So we're basically only good at digging rocks out of the ground and building houses.
Yeah, I mean, I hate to laugh, but it's true. And then that's what happened that's why, and just to connect the dots there, when I keep saying Venezuela, that's why they had hyperinflation, because they consolidated everything into the oil business. They nationalized it, and then they mortgaged it basically to the Chinese. So then when oil prices came down, they were pumping it out of the ground, but every single dollar basically went to China. They didn't have any left over for themselves. So they had to print the money to basically pay the bills, because there were no entrepreneurs, there were no businesses, there was nothing other than the oil industry, and that was paying the bills for the economy and all of their social spending. So if they wouldn't have done that, of course, then that forces the free market to take work, and it forces people to say, okay, well, I'm not going to get rich overnight in the real estate market. I'm not going to get rich overnight buying bankrupt Hertz. So I've got to figure out something else. Oh, I know. I'm going to go out and solve a problem in the real economy, create a small business that turns into a mid-sized business. And I would assume in Australia, it's just like the United States, where the majority of job creation doesn't come from Apple or Google or something like that. It comes from just small and mid-sized businesses. That's the driver of economic growth in the United States. Another thing I'd point out too, Alex, and I don't know what the stats are for Australia, but I would assume they're most likely similar. I did a video the other day where I went back and looked at the amount of government spending as a percentage of GDP. So if you go back to the early 1900s, ironically before the Fed, the government spent about 8%, or excuse me, the total GDP government spending was only about 8%. So in other words, private business represented 92% of the economy. You fast forward today, when you include the federal and the states and their total spending, they represent 40% of GDP. So that means that the private sector, what we consider the most efficient, dynamic way to generate growth within a company, has gone from 92% all the way down to 60%. And think about what they're doing now by propping up all of these zombie companies and the Fed's buying basically debt, and who knows, they'll most likely buy equity. So you have all of these assets going onto the Fed's balance sheet, and then you have the government running $3, $4, $5 trillion deficits, while at the same time the real economy is going down. So that means that the share of government spending is increasing as a percentage of GDP. So last year, let's say it's 40%. Well, now it's probably at 45. Who knows where it's going? So the government is becoming more and a greater and greater percentage of the entire economy, while the private sector is shrinking and shrinking and shrinking. And nobody is talking about this. And it completely blows me away. And I'd imagine it's probably the same in Australia.
I saw the figures the other day, and this is off the top of my head, but I'm pretty sure at the moment, with everyone on JobKeeper in Australia, I think it's 60 or 70% of people are now on the government side of things. There's only down to 40-30% private sector in Australia, which is just insane.
I mean, how does that just then ask yourself the question, if the government represents 50, 60, 70% of spending, at what point do we call that socialism? Or at what point do we call that communism?
Well, mathematically, it's just impossible to pay social benefits and retirement funds. Like, no matter if you tax everyone 100%, it still doesn't cover it.
Right, because the government's not producing anything. They don't produce goods and services. And regardless of whether you're an Austrian, a Keynesian, an MMT person, it doesn't matter. They all agree on one thing. And that's the rate of increase of goods and services has to stay consistent with the increase in money supply. If you have money supply increasing at a faster rate than the goods and services, that's when you get problems. And the government, the only, I don't know if you want to call it a good or service, but the only thing they produce, well, first of all, they reduce massive amounts of efficiency. So they're reducing the supply of goods and services the more they grow. But the only thing they can produce, if you want to call it this, is funny money. The only thing they can do is just print money. They just print money. They just print money, deficit spend. They run up the credit card. That's really all they can do. So if that's the only thing they're producing, and while at the same time the goods and services are falling, you can see where that goes very, very quickly. And it goes right into just make damn sure that you own Bitcoin and gold.
I think that's probably a great place to finish, George. I've got another appointment I've got to go to, but I'm sure everyone at home wants a part two, because I know I do, and we could just talk about these things all day. So I mean, that's just been fantastic. I think I love picking your brain. I know we're both like from that non-economic finance background, which I love, and you've got different expertise to me as well. So I think I love the chemistry. I'm going to put the links to all George's stuff down below, particularly the new service he's launching with some premium stuff, some extra content, some of the good macro players in the world that you've partnered with. George, do you want to just give us a quick rundown of that?
Yeah, sure. It's actually this weekend we're launching it. It's called Rebel Capitalist Pro, and it's a partnership I have with Chris McIntosh and Lynn Alden, two of the best in the business. And it's an online forum that has their research. We're building this community, member community, and then we're doing live stream Q&As. So every time Lynn or Chris comes out with a research report, we're doing a live stream Q&A for the members where we can discuss the report, we can discuss the research, and they can ask their questions directly to Lynn or Chris. And I'm kind of there just moderating, trying to stay out of the way and not make any mistakes. So anyway, they can go to georgegammon.com and find out more about it over the weekend.
Awesome. Well, yeah, that'll be out by the time you guys see this interview anyway. So, yeah, I'll put that all down below. Thanks for joining us, George. We'll have to catch up again in future.
Absolutely. Can't wait to do it again, Alex.
Cheers, guys.